Everybody for having me. It's great to be with you all. A Gatton alum, many moons ago, a serial entrepreneur. I'm currently executive entrepreneur in residence, so with the National Institute on Aging, where I coach a portfolio of medical device and digital health and age tech awardees through the SBIR program. I also integrate with my colleague who does therapeutics and devices also. We cross over. I have two companies in the healthcare space, one in consumer products and one in education. And my perspective is I've been on all sides of this equation. I've been invested in, I've been pitched and not got invested in. I've invested my money and lost it. I've invested my money in myself and lost it. I've invested money in myself and been successful. So I think the key is perspective. So I'm going to share with you a perspective, but I want you to pretend with me for a second that everyone on this call is just going to receive $50,000 unrestricted today. And with that $50,000, you can do anything you want with it, right? So we're going to change and transform the first part of this discussion into what an investor mindset looks like and what it feels like. And so you have this money, and so we're going to start this conversation today with this money and what you can do with it. So I'm going to go understanding an investor's perspective. Most of us think we're pitching and selling, trying to stand out in a crowd, trying to convince somebody to give us their money. But you have to understand from our investor perspective, we're all wearing that hat today with our money. And the first thing is cash is king. Investors have all the choices, right? Those who have the cash can make the choices. So this concept of risk versus reward, and I'm going to be really simplify this for a second, but there are plenty of places I can take the principal of my cash, my 50, and you can decide what to do with your 50, but we could bury it in the backyard. We don't make anything, but we don't lose anything if we can figure out where we buried it. We can put it in a savings account. We can put it in a CD. The CDs right now paying 5.79%. Pretty good to not have any risk to lose your money. Then we can get a little more risky, right? And we can take it and we can invest it, right? So when we invest it, there are returns. We have everything from bonds to the S&P 500. S&P 500 did 24% last year. Think about your 50 making 24%, pretty good. Some of you get a little more aggressive. You can pick Apple stock, returned 45%. Think about your 50 making 45%. And then I always do this, and it gets kind of a smile, but I always ask you to think about the casino. The casino is an unlimited gain or loss scenario, right? And I think that investing in startups, depending on where they sit in their life cycle, is much like a casino. You could take as much risk and get as much reward as you want. But most investors, given the risk, are going to look for 3 to 500%. So if I give you 50, I'm going to be looking for 150 to 200 when I successfully exit your venture, and that is my return. And the time frame is 3 to 5 years. And so we're hoping you're successful. I know that not all of you, all of our $50,000 bets are going to pay off. So the ones that don't pay off have to be covered by the ones that do pay off. So that's why the expectation's higher. So the key is each investor has a flavor, just like all of us in food or ice cream or whatever we choose. We have a go-to type, right? So in the investor world, I break it down this way. There's a flavor for the stage of the company. Early phase, revenue already achieved, break even. There's a flavor for the type of company. I just put some technology examples here. If I like therapeutics, medical devices, it's very different than prop tech, which is all about living spaces and technology integrated, AI and Alexa and all the prop tech players and finance, find fintechs in the middle. Healthcare is never going away. Then what kind of solutions? Do I like software? Do I like hardware? Do I like formulations? Do I like it? Do I like SaaS models? Then the thing about it is you can figure this out when you're thinking about your investor by doing research. On their websites, they have their portfolio. You can look at the companies they put money into. There's a software called PitchBook that can go out and you can search the types of deals they made, how much they paid, how much they put in. But every one of them has a size. Every one of them has a size commitment they're interested in making. And think about it. If I'm a $50 million investment fund, and I did it in $50,000 chunks, that's an awful lot of things to keep track of. But if I'm a $50 million investment fund and I did it in $5 million chunks, that's 10 portfolio companies to keep track of. So they do it based on the size of their fund and how many investments they want to make. Now, how they make it is the type of investment. We hear about safe notes. I'll make a comment about that. They do it as straight equity. They do it in convertible notes. There's all different instruments. You can tell in your qualifications and research, and even in your first meetings, what type, what size, what they invest in. And then the fund, as I mentioned before, they like to be involved. Most of these are not going to be just passive, drop the money off and come tell me when it's all successful. They're going to want to be some involvement. Mostly is going to be board. They're going to assign somebody to be involved with the company. So at the end of the day, they want to be able to track and support your success, but they want to add value. And you want somebody that does more than just add money. You want somebody that adds value. And how do you get them involved? Well, you tap into their network, you network with them to know them. You actually have to be in the mindset of recruiting investors like you look for customers at trade shows, at market events, on LinkedIn. And then you have to and somehow get them involved. The more you have them involved on your board, your advisory board, in any capacity, the more the dialogue begins and the relationship begins. So the art of the deal goes to the valuation methods, the valuation methodologies. So each each formal type of valuation is, to some extent, we all think is an accounting matter, but it's not really an accounting matter. It's a business philosophical and business calculation. But as a CEO of your company and your venture, even no matter what role you have on the leadership team, you have to understand the principles. So the best principle is to find other companies like yours, other ventures like yours that have been funded before. And so you have market comps. The best way I can tell you is real estate, the house down the street, what did it sell for? And what did it have in terms of its amenities, bedroom size, garage, pool to your house, so to speak. But the formal accounting methods are these first four. The first one is there's a multiple of revenues. Well, if you have zero revenues, multiple of zero is zero. But that's where pro formas come into play. If you don't have revenue now, whatever your projections are, whatever you value the company when you take money is going to be a multiple of some revenue calculation, either actual revenue or projected revenue. Actual revenue is giving more credit, a lot more credit than projected revenue. But projected revenue, the key is going to be actual time will tell if you're a good predictor of revenue. Multiple of earnings is only after you're profitable, even if you do have revenue. This little acronym that everybody loves to throw around, earnings before interest, taxes, depreciation, and amortization. The reason it's this way and not just net income or operating income is because interest, taxes, depreciation, and amortization are considered not comparable among companies. If I'm in a different interest rate than yours, if I'm in a different tax bracket or state than yours, depreciation and amortization are both non-cash transactions. So that's why we go to EBITDA. And if you're not profitable, multiple of non-profitable earnings is still zero. Fair market value of assets. A lot of us are in the technology world and we have IP assets and intangible assets. We don't have buildings. We don't have equipment. But one way that's a standard methodology is fair market value of assets. And then the one that's used in modeling when there is no revenue and earnings is this whole idea of projections, taking projections out to multiple years and using discount factors and risk factors to get back to a current day price. And then the one that all the people that have ever interacted with me know, this is a straight out negotiation if these other pieces are minimal. And so every founder has beauty in their eye for their behold baby. They love their venture. And so this comes down to what will you give up for what you need? So think about it this way. If you needed $100,000 and you're willing to give up 10%, by default, your valuation is $1 million. 10% of a million is 100,000. But if you want to give up 30%, but you need $500,000, then, or let's say 50% and you need $500,000, your valuation is still a million, but you've lost 50% instead of 10%. And you haven't really lost it. What you've done is you've added a partner to your equation that owns part of your venture. And so if the money comes in and the deal is right and what you give up helps you get to the next inflection and milestone and revenues and earnings, it may be a very good deal. But a lot of times as founders, we need to just realize that we have a number in our mind and we have an amount in our mind, and we need to just do the work to make sure the investor sees why we and how we think it's fair. Comment on safe note. A safe note, everybody thinks it was a magic to some regard to avoid valuation. It doesn't avoid valuation, it defers valuation, meaning that when you do finally get the money in and the investors and all the paperwork in, you're going to have a valuation. All you've done is given yourself a chance to take people's money in, to give them high level deal terms, and to use their money while you're trying to raise the rest of the money. And the way you do that is you give them a promise of two things usually. One is the valuation we'll finally take is not going to be more than X. In our last description, we talked about wanting to give up 10% for 100,000. You'll tell the people that give you money in your safe note that $1 million will be the cap. If we raise money at more than $1 million and the price goes up, so to speak, you're guaranteed that your money is going to be at $1 million. And some other way, sometimes they do it is if and when we finish raising the other money, we'll give you 20% off the final share price. So whatever the valuation is, we'll give you an extra discount for taking the risk with us early. And so the key with that, though, is this somehow, when you do your first formal close of capital, you're going to unknowingly or intentionally have metrics and formulas, multiples of earnings, multiples of revenue, that are going to become inherent for future valuations. So think about not trying to be unrealistic when you do this, because it's going to come back to where the investors, when you run out of money the next time, are going to go, yeah, you said it was worth $1 million, but it really wasn't. And the next time you go raise money, they may make you take money at $500,000 or some other number. And at that time, all the people you took in early, all your friends and family, all the close people to you are going to be diluted and going to go backwards on their investment. That's not a good place to be. I like to look at how you should think about your venture from our standpoint as a investor. I think about you as feasible or viable. Everybody says minimal viable product, minimal viable solution. Then I like to think about you got something that works. Can you replicate it? And replicate it could be to your best friend or your best friend's company, but that doesn't necessarily guarantee me that it's scalable. And once it's scalable, then at scale, how can I make sure the rest of delivery and operations guarantees sustainability, that you'll be around, that you'll at least make break even, and that with the cash you have a runway to stay in the game. And then at the end, the highest pyramid peak, we're going to look at profit and increasing profit and growing profit. But this is a labor of love to scale this pyramid. But I'm looking at where you are in this pyramid when I look and hear from you that you want money. So here's an exercise. We won't go through it on this call, but I strongly recommend you do it. I gave you 10 risk parameters that an investor uses either intentionally in a formal scorecard or just in their head in a theoretical scorecard. But here's 10 areas where if you think of this as 10 questions with 10 points each, you be the evaluator for the day, and go through and ask for each one of these questions to your venture. Where do you score on the continuum of 1 to 10? In market risk, business model risk, financial risk, dilution risk, legal risk, execution risk, differentiation risk, competitor risk, intellectual property, and domain risk. The key here is what I'm getting you is all the factors that come in on how I rank your opportunity to take, in our case, as we're proceeding on this call, a $50,000 risk on you, right? I got those other choices we talked about. The casino's still able to be an option for me, but I'd like to consider all your deals collectively, and I'd like to somehow score them against each other. And these are the parameters that I would use to do that. And the key is, as good as you rank yourself, we're going to talk to the next phase of this presentation is going to be what proof can you provide me to support your score? So now we're switching to the second part of this is how you're going to up your score, and this is how you're going to close the deal, and this is how you're going to reframe your thinking, because you're no longer going to be pitching, you're going to be asking to partner. And when you ask to partner, you're going to have elements that you've taken into consideration to prove your case of why you would be a good partner, as opposed to trying to wow me with fancy pitches, fancy presentations. It can't be all show and no substance. And I'm a big substance guy. I gave you a meaty presentation here without good diagrams. I usually don't coach people to do that, but this is a lot of meaty stuff, and I wanted you to have it. And so I didn't dress it up. And I usually get some good people that do good dressing up to make presentations when I go out into the market. But this is all meat and straight up information you should strongly consider. So proof matters. If I'm going to up your score, here's some ideas of proof, right? So what data, what evidence, what size, why is this an issue? What can you give me about the problem that makes me feel like it's less risky than I thought? What's novel and different about your solution that allows me to trust that you have an angle here? Do you have any regulatory or IP protection? And they call it a moat around a castle. If you remember, a castle, one of the defense mechanisms was a sort of a watery moat, a watery area where it was trouble to get over that unless you had a bridge. So the question is, how can you secure your castle of innovation, your castle of opportunity from other competitors who want to come in and take over your area? Customer discovery, do you have evidence of interviews, and did you go through any formal process there? I subscribe to the idea that just because you're not a device or a drug doesn't mean you don't need trials. So at the NIA, when we give you an SBR grant and you win one, you do trials. You have defined methodologies of trying and verifying that what you assert is true. It's very similar to how they do drug clinical FDA trials. We do it for software. We do it for software as a service. We do it for digital health, any kind of technology. I called the theory of the 5 Ps, but if you want to do something, write yourself a nice paragraph that tells me who's going to buy your product, describe your product, kind of like a restaurant menu. Give me the price of your product and how it's sold, the unit of how it's sold. Is it per year, per month, per bed, per person? Give me where we meet. Where do you meet the customer? Is it a trade show? Is that online? And then give me the messaging. If I walk by your virtual booth or your social media post, what's your angle? I call it the billboard model. If I drive down a highway, see a billboard, I know certain billboards, and the picture shows me what they're trying to get me to take really quickly. And so the promotion lines, the taglines, sometimes they call it, has to be poignant to describe what the value proposition is. Do you have any customer contracts? They might not have to be implemented. They might not all be big revenue producing, but that's a big de-risk lever for me. Letters of support, key KOLs, they call it key opinion leaders. who in the market in your sector is a market leader and what can they say about what you're trying to do. And then I'm a big proponent, more so in the later years now, of the value of academic research collaborations and the whole idea of bringing academia into business and looking for contributions to science as well as profitable ventures. So my primary concern, and we're going to go through and you're going to look at these and go, hey, these are the elements of a business plan where you're supposed to put these 5 important things together in my pitch. And this is exactly what we're going to talk about. My primary concern is how well and in depth do you really know your market and your competitors. That as an investor to me is almost everything. It's who knows it and how do they know it. And so we'll talk about your team in a second, but if we've heard about this TAM, SAM, and SOM, this is going to tell me if the top of the pyramid is reachable. It's going to tell me scalability, right? Total addressable market, service addressable market, service attainable market. You got to express these things in dollars. People show me that there's an awful lot of people that are over 60. Well, I know that there's a whole lot of baby boomers, but the number of customers times the dollar revenue per customer you're going to get on an annualized basis, and then how much of the overall market of these customers you're going to get is what this slide is going to tell me. And if you don't convert it to dollars, I can't convert it to profitability or to thinking of how your projections make sense, right? So then this gets into the competitiveness. What are the features and benefits, the parameters, the distinctions that make people choose? Think about when we go out to a restaurant, we choose the type of food, we choose a price level, fast food versus fine dining. We choose all kinds of things, and they do that. The consumer does that for all your innovations. Whoever the consumer purchaser is has these delineating characteristics they use. And then we have this concept of a primary and a secondary market. Is there a primary place where you can dominate from that dominant market share spot? Can you branch out into other smaller markets? Great quote. Somebody I know and respect a lot in the market says the riches are in the niches, but if you don't own any niches or find any niches, then there is no riches. So the end of the day, it's not, you can start in a small beachhead market and you can expand from a primary market to a secondary market, but you got to have something the customers want. You got to have a market that's big enough to attract a return on investment. And that's what investors are looking for. How's my money going to make 200 to 300%? Team and the gaps and how you will address. I've gone big now into coaching our teams and advising and put an org chart. Show me who's there. Show me who's got spots filled. Show me what's open. And then you give me logos, give me the power of their background, give me something about why the people you picked around you, board members, advisory board members, operating team members. I'm okay with gaps, but I'm not okay if you haven't identified and tried to determine how you're going to fill them, right? You, as a startup, you're going to have third parties, contractors, service organizations. Tell me about who they are and why you picked them, right? And then the end of the day, you got to think about securing all the institutional property, intellectual property. So ownership rights of anything your team develops in a fast-moving new venture. Work for hire agreements means that somebody does programming for you. They don't own the programming. You paid them and they give it to you and you own it. IP rights, confidentiality, non-circumvent means they can't go around you and talk to somebody they met through your work, through your relationships. Non-disclosures, they can't share something they know from working with you. A non-solicitation, they can't come back when they leave and take your key members of the team and move them to their team. The use of funds in the business model, I'm going to ask about these projections, and I'm going to camp out there on not if they're perfect, but if they're well thought out and if they're backed up by any independent evidence. So what are you going to take and do with the money? Show me a plan. Create a pro forma to show me if you do use that money, what happens? And then if you have a go-to-market strategy that's defined, that really helps me, right? And can you do multiple channels? Can you go multiple ways? Can you go business to business, B2B? Can you do B to B to C? Can you do B to C? Can you do all three? And so I put here a link to something that I like called the art of profitability. It talks about a cadre of business models that startups could use or adapt or think about. But what does it tell me if if you're trying to get my 50,000, that you've thought through these profitability models, you've referenced external resources, you've made P&Ls, you've got a good team, and you've put it all together, and here's what you're going to assert, and here's how much money you need, and here's what you're going to do with it. My confidence starts going way up, right? SBR grants, I'll be honest with you, all the years I was an entrepreneur, I had no idea they existed. To those that figured it out, kudos. To those universities that are promoting it, kudos. It's non-dilutive money straight with these heavy parameters of due diligence and trials and research project overlays, but it surely can de-risk anything you're trying to do. Now, it's a hefty process. You probably need some good academic collaborators who know this process, because all the universities get what they call STTR grants, which funds a lot of university research, but those are inside the institution. These are for-profit versions of that grant when they roll stuff out, make it commercial businesses. And then celebrate to me what you know, but don't make it overly marketeering, right? Milestones are great. Awards are great. That you did accelerators that are great. You got grants, that's great. But the key is you got to make sure I know why it's relevant. Not that you just did 50 pitches and made a little cash doing pitches because you're a good pitcher, but I want to know why it's relevant. And I want to see the progression of the business model as you develop these experiences. The hardest one, entrepreneurs were not taught governance in school. Well, maybe now we're taught more about it because entrepreneurship's become more full circle. But how's the deal really go down, right? What happens? So I want to just spend a couple minutes on this. Governance is critical. So no matter how much you do on dilution and shares and percentages, the corporations are run by the board of directors. So if you have 60% of the shares, but you have one seat out of five on the board of directors, you don't really govern what happens to the company. Now, you can vote your shares, but the board of directors will be the ultimate governance of the company. So you have to think about that almost as much as you have to think about dilution. Advisory boards, they don't have voting rights, but they're going to credential you. So put the right people around, make sure they're bought in, make sure they feel like you've respected their time, whether it be options or a little equity, or make sure you've at least considered an hourly rate that's pretty aggressive for these talented folks, and have some recognition for them that becomes a sort of equal representation of their contribution and their network and their institutional intellectual property. Voting rights, in these term sheets, when you land these investors, there's going to be classes of investors. There's going to be class A and class B and sometimes more, and that's different than Series A or Series B. This is that some will have preferences over the others in terms of when things are liquidated, when things are converted, and they really, the preferred shareholders or the classes with preferences are going to outweigh the common shareholders or the rest of the shareholders. So this gets into more than we can handle today on term rights, but we talked a little bit about voting rights. We talked about the shares, liquidation preferences. Some shareholders go before others. Tag along just means that if I sell, you can sell, and that nobody can sell and leave us all in the deal and they all run out of the deal. And if we put more money or the company needs more money, the current shareholders get to put money in first before external money comes in and reduces their percentages. The ratchet clause was one I learned where you go back to your second round of funding, and they put a little clause in there that says if the first round was wrong or was way overdone, the second round they can go back and change the first round to the second round price, and that's a really hard lesson to learn. So be careful of that and understand what it means. The impact of dilution, we talked about that. So let's just make it clear. If I give you 100,000 and your company's worth $1 million, and you give me 10% of stock and I want 300,000 return, if we don't take any other money, you've got to be worth $3 million when you exit, and I still got to own 10% to get my 300,000 and my 3x return. Now, if you dilute me and I own 5% of the company, the valuation of the company when you sell has to be substantially more than 3 million for me to get my 3x return. And so it becomes a math equation, but you got to be very careful that if you pick a higher valuation early and you think you did a good job, it may come back to hurt all the early people you brought in, which are usually all the people closest to you, because it was unrealistic to begin. You couldn't make all the projections, they were lofty. And then when you went to raise money the second time, the professional money came in and readjusted the valuation, and all the people earlier got diluted pretty heavy. And that causes emotional stress as well as financial stress. And I don't recommend that you try to, I do recommend you try to be very sensitive to that. Stock option plans, when you think about teammates that come in later that are not founders, and you want to have room for them to own something because you're going to pay them less than market rate, then you got to reserve 20% of the stock. Well, if you reserve 20% of the stock, I, as an investor, is going to make you do that before my money comes in. So everybody that's there before will be 80% owners. Reserve for future employees will be 20% owners. Then my money will come in. So the dilution of my money plus the dilution of setting up a stock plan is going to be double dilution. And so you got to understand the math on how that works. And then cap tables is the ownership tables of the company. We're going to be very focused on that when we take new money in. There's a pre-money look. So that's like just what I said, that current owners and founders, current money in, stock option reserve, that's going to be a pre-money number. And then post-money will be after my money comes in, the valuation of the company. This is a good pictorial of how it works and the traditional value of the valley of death. And it's the whole idea that we have an idea, we prove it, we go to accelerators. If we're fortunate, we get SBIR grants. We're in the pre-seed stage. We get self, and then we get our friends and family. This is that valuation risk I told you about. And then when we get to seed stage, we start getting the professional investors, the angels. Then we go to early stage when we start having revenue and we start getting to profitability. We go to later stage types of investors, venture capitalists, strategics, meaning that they're somebody that's in the space that could be a customer. They give us capital to work together. And then the later stages, the final sort of relevant stages for every company is to think about an IPO to go on the public market. A heavy majority of them will never see that. They'll be either acquired by a strategic or sold in a combination in the growth phase. But the key here is, if when you get to pre-seed and before you get to angel, if there's not enough proof points and there's not enough de-risking, then you end up running out of money. The other money doesn't come, and all of a sudden, that's where 8 to 9 out of 10 just kind of stop. And so don't be afraid of stopping. I've got a lot of those on my pedigree. Sometimes that happens, but that's the idea of kind of learning and moving on. So I'm going to finish up with my lessons learned. One, the overall arching goal here is be realistic, which you heard from me in a number of ways. Be yourself, right? Be realistic about who you are. Be realistic about the team you have and need and who they really are. And because early stage teams and later stage teams might not be the same team. That's awful hard because we start something together and we don't get to finish together. But you have to be realistic that your job as the fiduciary and CEO is to protect the company and the investor's interest. And then the opportunity. What is the realistic opportunity? I would strongly recommend you do my scoring exercise and be realistic. So personal learns, right? I really found more about my competencies, not from my self-awareness or emotional intelligence, which I hope I've continued to sort of build upon from the early days of just straight bravado and straight straight, stubbornness that I wasn't going to fail. But others were most helpful in me getting insightful about what true competencies that I could bring to a team and what competencies I didn't have that would be best brought to the team from other places. And I've learned, and again, a little gray hair helps, weaknesses and dislikes and mistakes and unknowns. It's okay to be transparent with your team. I think it's okay that to be transparent, you have to admit mistakes. You have to say you don't know. You have to have weakness, and that doesn't make you a terrible leader or a weak leader or too emotional of a leader. That makes you a real leader. I mean, just a real transparently, and people will build trust knowing that you're open and reflective and that you don't have all the answers. Now, you can't say you don't know have all the answers and not have a plan or a strategy. That's a mistake. I've adopted a leader as a teacher model. This is an example where I'm taking learning lessons and sharing them with you with the hopes that you'll share them with other people and that it'll make an impact for you. I always look for mentors and advice, and I never change a moment never miss a moment to try to grow as a leader. And because I grow as a leader, then I can also be a mentor. So have a mentor and be a mentor is a good way to grow your leadership. And the people that work with me know that I use this expression. I like to outthink, don't outwork or outspend. I'll have the executives and teams that I work with. If you have to keep a time journal of how much thinking you did versus how much working doing activity stuff, we all feel like the more we do, the more we'll get there. And then look at how much you're spending and ask what was its impact. I like to thinking is relatively inexpensive. It is your time, so it's not free, but it is very valuable. And I use this. You're always one yes away if you ask the right question. So if you're in a mindset to get in the right audience with the right investor for the right reason, with the right support, you can get a yes, but you have to ask them for something that meets what you're bringing them. And I don't think this market seems really frustrating. It's really harder than it's been in a long, long time. So you're not the only one. And the valuations are small and low, and there's a lot of money sitting on the sidelines. But at the end of the day, the ones that de-risk, the ones that do the steps we shared in this presentation, you're going to be the front of the line. And I don't know if any of you have already spent on in this quick time period, you're 50 and figure out what to do with it, but you can see how investors get nervous and go really conservative, right? Because they haven't seen anything that's given them enough proof of de-risking, that's given them enough competencies in the market, the team, the problem, the novelty, the business, financial. They don't see enough to pull the trigger. And so you'll have to put that in your mindset when you go to present yourself. And then I love end zone celebrations. You don't see too many of them that look very good with one person by themselves dancing around the end zone without their teammates running up and jumping and celebrating with them. So this is not a solo sport, and don't embrace the solo sport part of it. You didn't win, your team wins, the venture wins. The venture includes your investors. They all win together, they all lose together, and you can't make it personal. It's not personal. Um, you learn more from failures and success. I say fail fast, learn and move on. It's always a great hardship emotionally when you fail. We all think we're, too good to fail, too smart to fail. Sometimes it's darn timing. Sometimes it's market conditions. You had no idea. Sometimes it works in your favor. We have a healthcare training company. The government during COVID eliminated the need for training. Imagine we have one product, one course we sold to nursing homes to train certified nurse aides, and they eliminated the need for it out of all of COVID. I thought it was going to be a month, then I thought it was going to be 6 months. It ended up being 2.5 years. And who could have predicted that? All the best plans in the world. The company was growing, and we didn't stop. We just had to regroup. We had the trust. We had the transparency. We had to know there was a lot of unknowns, And today we're flying higher than ever because we made it through, and we all feel just the celebration of making it through. So that's my personal lessons. I'm going to stop. I think we have time for Q&A, maybe 15 minutes. But I'm going to give you my personal mantra to enhance lives by sharing your knowledge. You saw me out commenting on this. I love the Von Allman Center and the work they're doing. Warren and Miriam have been just taking this to a whole nother reach, and this kind of content. I saw and went back to some of the library sessions. They were great. The one on the personal investing from our board chair, Silas, was awesome. I try not to duplicate things and just be additive to those, but those are good resources also. With that, I'll take questions.
Thank you so much, John. That was an excellent presentation. We do have a question in the Q&A from Tanya. Tanya, please go ahead.
Hi, thank you so much, John. That was really insightful. I want to ask a question related to the two scoring systems you showed. The first was like the pyramid, it's just a scale really. And then the second you were saying that you could score yourselves out of 10, and then you had the lists. The question would be just to check, is one low and 10 best performance?
Yeah, I mean, I think you can do it either way. It's the same answer. I tried to think of it out of 100%. So I'm thinking of my question, would I invest? What's my percentage confidence in investing, right? And if it was 100%, that means all the 10 questions were 10 points. But what I was trying to get in the pyramid is some investors only play in certain levels of the pyramid. If you're not profitable, I don't invest there. If you're not scalable, I don't invest there. But some of them do invest in you're just feasible. So those were just a mindset. That was a mindset of an investor pitch. But I would do it out of 100, and I would scale it 1 to 10 and add up to 10 questions.
Right. Thank you. And does that can you sort of extrapolate where you are roughly on that score to where you are on the pyramid? So for example, if you're maybe 80,
Well,
would you be sustainable?
yeah, well, I think they're different. I think sustainable is an economic uh, assessment of
Right.
you have revenue and income and uh, profit. I mean, you have revenue and income and capital to equal that you can stay there, right? So those are two different things. The scoring one is how I intrinsically compare you against everybody else's venture that's on this call.
Right.
So if I score you 70 and I score them 80, they're more favorable to me. But the pyramid is just a mindset of you knowing where you are, because it's akin to how types of investors, friends and family, do feasibility levels. The highest end of profitable is Series A or B venture capitalists. So that's how we look at it.
Thank you.
Mhm.
John, we have another question in the chat from Allie, who is actually lack of a microphone, so I'll go ahead and ask this. The question is about how to find investors and how to identify a potential investor. So do you have any tips on that?
So the question is I camp out on LinkedIn, and I camped out on LinkedIn and trade journals in my sector to look for the movers and the shakers and the players and the commenters and the article people in the articles. And then I do a lot of connecting on LinkedIn, right? And that builds a network of people that know other people that know other people. And when you pull up your profile, you see who else they know. But then I do PitchBook. So PitchBook is a software service, and it's not, I think it's available mostly, I know universities have it. I don't know if individuals really subscribe because it's a little bit pricey, but we have it so it allows me to go to any sector and look at the investors that play in that sector. And then the third thing I always do is trade shows and conference events. I look for the speakers that are on the panels that are meeting my interest, and I stand there at the end of the panel and shake their hands and introduce myself, and try to then connect on LinkedIn with them post conference.
Thank you, John. Well, it looks like we don't have any more questions in the chat. Everyone has put some very positive comments, John, in the chat about what a fantastic presentation this was today. So we want to thank you. And
I did have a quick question, Miriam. Does
yes,
anybody will anybody give me a comment on the 50 that the hypothetical 50 I gave them? Would they take a risk on a startup, or would they do something else knowing our current market conditions and the value of 50,000? I just want to play an investor mindset game just a little bit and see if anybody will flush out for me. If I gave you 50, what in this time period, in this economy, with these market forces, would you go for startup, or would you go for one of the other modalities, or would you bury it in the backyard? Anybody want to share their mindset of that? Because I think this time in 2024, with this economy, an election year, certain things happening in the world, I think you have to get in that mindset to think about going to pitch. What would anybody share their thought process on what they do with their 50, hypothetical 50?
well, this might be a good segue for me to call on someone who did actually put another question in the chat. Jonathan Melman, since you had a question about a warm intro to investors, can you answer John's question?
Sure. Can everybody hear me?
We can hear
Sure.
you.
Okay. Sometimes the microphone doesn't play nice. So, from my perspective, I would not invest it in a startup, but that is a de-risking step because I'm heavily involved in startups, both my own and consulting with others. So I would want something a little safer because I'm already, my primary cash flow is pretty risky.
So it's a diversification thing. You have enough high risk that you wouldn't do more high risk as your part of
Right.
your portfolio. Okay.
Yep.
Anybody else want to give me their thoughts on risk thinking, and did it help you think about it from an investor's? There's somebody with their hand raised.
Yes, Tanya, go ahead.
Yeah, I would go for it. I would actually invest in a startup, but I think for me, the logic would be that sometimes in these kind of really difficult times probably are the best opportunities. And I'd sort of be looking at teams or startups that are solving problems that are more social, that are really tangible and maybe a lot more practical. So yeah, that would be my mindset. Go for the risk and see it as an opportunity.
I mean, that's an excellent comment. I mean, the thought is the investors are professional money makers on investing. They can't not invest. So the ruse of my 50 was, if I'm an investor and I make money investing as a fund, a venture capital fund, I can't sit on the sidelines because I'm making no money for my partners and limited partners and general partners. As an angel, I can sit on the sidelines because it's more of a recreational sport. But in the formal funds, they have to find things, because if they don't invest, they have no return and no income, because their income comes from investments that win. So I think your point is they'll be investing. The question is, does it shift where? And that is very true. It does, based on market conditions and practical things that you talk about. Here's another thing that I'm gonna ask you. How many of you that are doing deals now are caught up with having in your PowerPoint currently, if you're a deal person, how many people have AI, machine learning, keyword searching? How many of them are using the current buzzword of AI? And do you all feel pretty comfortable that's a buzzword, or is that really transformative? The only reason I ask is because a lot of people, I see it in every single pitch on the digital health age tech side. And when pressed, a lot of people can't explain what it does or why it does it or how it's effective. And I'm just wondering, do you all think we get caught up sometimes in hyping up concepts that maybe don't have their, they're just real undefined yet? Do you all feel that way?
Hey, John, this is Jill. Thank you. That was an excellent presentation. I actually do more marketing and comms with startups, and I see it as I'm interviewing potential clients. And I agree with you as I'm pushing them. And as we're going out, I'm like, if you don't have a really elegant answer for how you're using AI and how it's making your solution better, then I don't even want to see it in your comms.
Yeah. I mean, I think it's a big risk. Everybody thinks they need to throw something in there. If I talk to investors, which I do regularly, don't you think they get worn out? They get worn out seeing buzzwords and concepts and things. But the end of the day, I don't want you all to miss this. It's a financial transaction. It's a return on an economic investment. It all comes back to those things we may or may not like, which is the pro formas and the financial statements of the records of our endeavors. And so if you're not an accountant, you should really get one. If you're not a lawyer, you should have one, because at the end of the day, this is legal and financial at the heart of it. Everything else is how to tell a story, which I'm sure you all can be excellent at. But telling the story that has no proof and no substance, it's just a short-lived game, because you're either going to figure it out or you'll be in the valley of no return. Anybody else, Mary? You got? Anybody
John,
else want to share?
I think we covered up quite a bit here. Tanya definitely is firing us in here in the chat. So Tanya, she says she's based in the UK. Quick question with the SBIR, is it US based only?
It is. You have to, well, the company has to be 51% owned by US US owners. I mean, you could, and you have to be based in the US, but it has to be, most importantly, has to be owned by US citizens in the 51% category.
And Tanya, just so you're aware, we have a lot of resources here in Kentucky. I believe we have someone currently on the call with us today, Mahendra, who was very active in that space for a long time. Mahendra, can you speak to the SBIR program if you're available to?
Sure. I think SBR, as John indicated, it's a non-dilutive funding is very important for de-risking the technologies, and one can take any risk there. Proof of feasibility is done, and then you start taking that technology to develop that into a product. Before then you start looking at it, what is that product that will have the market and all that. So I think SBI funding is very, very important. And fortunately for us in Kentucky, the state is coming out, has come out with the matching money that solidifies again and gives more money for startups to develop that product. And so our angels and then investors can feel that, yes, there is a market, there is a product out there, and it's important that the company will need more money now, and we can take that risk of investment now.
Thank you, Mahendra. I was taking some time to put some information in the chat.
I see one more hand up. But
yes, that is.
Hey, John, how are you? Thanks for that
Okay.
presentation. So helpful. Do you mind if I ask you to share your insight as to governance models that you've seen have been more beneficial or attributed to like long-term success?
So the end of the day, we do a combination. Well, obviously the board is always an odd number, right? So 5, 7, 9, however you go there. We always start with 3 on our board on the governance side. We do, we try to do 1 money and 2 founders. That's where we started. Then we go to 5. We bring in a professional service player, legal usually, and then we try to bring an industry expert. And so the key is, knowledge and ties to the founders. So we try to always keep 2 founders on the board. So then we're really worried about a swing vote, 3-2. We haven't really had any issues with our current, we have a family firm that funds our 3 companies currently, and they're a very friendly board scenario. We've been in scenarios when we had more professional firms and 2 or 3 of them, and they get in and they move us. But what we found is if we're clear on always communicating, always sharing financials, and always getting buy-in on the strategy, then we don't have problems in the governance side. It's when nobody hears anything and financials are not regularly done that we have governance problems. The advisory board is always very company friendly, and it's always very leaning on the board to support our strategy thinking. And it's considered the voice of the industry in the advisory board. You get the scientists, you get the other. We don't have a advisory board per se in a formal sense in the healthcare training company, but we do have customers. And if the board ever has an issue, we ask them to talk to our customers as advisors to say, hey, these guys are on the right track, or this is the next thing to solve. But does that answer your question?
Absolutely. Thank you so much. Appreciate it.
Mhm.